Welcome to Explain the Charts, where we break down the most significant moves in the Forex market. Today is March 25th, 2026, and we are focusing our analysis on the USDCHF currency pair. The current market environment is dominated by high geopolitical tensions in the Middle East, specifically regarding Iran. News reports indicate a potential one-month ceasefire is being discussed, which has introduced sharp two-way volatility. Additionally, we are seeing the impact of trade policy headlines, with reports suggesting a 15 to 20% tariff on EU goods could be on the horizon. The US dollar is also reacting to domestic policy shifts, including President Trump's recent comments on energy facilities. From a central bank perspective, the Federal Reserve has held rates steady between 3.5 and 3.75%. Meanwhile, the Swiss National Bank has expressed an increased readiness to intervene in the forex markets to prevent excessive franc appreciation. These fundamental factors create a complex backdrop for the technical data we are about to examine. As of today, the USDCHF is trading near the 0.7890 level. The interest rate differential remains a primary driver, with the US holding a significant yield advantage over Switzerland's 0% rate. Traders are currently looking for clarity as they weigh safe haven demand against cooling inflation hopes. Zooming into the daily chart for 2026, we can see a clear recovery trend starting from the late January lows. The price action successfully bounced off the 0.762 range and has been making steady gains. However, we are now approaching a very significant confluence resistance zone near 0.7926. This level represents the 2026 yearly open and aligns with major Fibonacci retracement levels. The daily candles show that bulls are struggling to maintain momentum as we test these psychological barriers. If the daily close can settle above 0.7950, it would signal a major bullish continuation towards 0.80. Conversely, the emergence of long upper wicks on recent candles suggests that sellers are defending this territory aggressively. The daily RSI is beginning to show some signs of divergence, which often precedes a short-term trend reversal. We must also keep an eye on the 100-day simple moving average, which is currently acting as a pivot for sentiment. A failure to hold current levels could see the pair retrace toward the 50-day SMA at 0.7798. The broader trend remains constructive, but the lack of follow-through at resistance is a warning sign for long-term buyers. Traders should watch for a daily candle close to confirm if this is a breakout or a double-top formation. Switching over to the 1-hour chart, we can analyze the structural developments from earlier this month. During this period, the pair showed significant respect for its moving averages as it attempted to build a base. Notice how the price consolidated between 0.778 and 0.783. This range provided a launchpad for the more recent move we are seeing today. On the hourly time frame, we can see how the price action reacts to intraday news spikes with high precision. Support levels were consistently defended during the London and New York sessions, showing strong institutional interest. The break above 0.780 was a crucial turning point for short-term sentiment. This hourly data reinforces the idea that 0.780 is now a rock-solid floor for any potential pullbacks. We also see that the volume was particularly high during the European morning sessions, suggesting active SNB monitoring. If we see a repeat of this consolidation pattern, it would likely indicate another leg higher is being prepared. Currently, the 1-hour chart suggests a neutral to bullish bias as long as we stay above these historical swing lows. Now, looking at the 15-minute chart for the last 24 hours, we can see the micro-volatility in action. The price action on March 24th shows a series of sharp spikes followed by gradual retracements. This behavior is typical when the market is reacting to headlines regarding Middle Eastern ceasefire negotiations. Specifically, we saw a bounce off the 0.787 level during the Asian session. Resistance has firmly established itself near 0.790 on this shorter time frame. The 15-minute candles highlight how quickly liquidity can dry up, leading to slippage during major news releases. Scalpers should be looking at the 0.7880 level as a key intraday pivot point. A breakdown below this level on the 15-minute chart would likely lead to a test of the previous day's lows. The volume bars show significant exhaustion at the top of the current range, suggesting bulls are tired. However, every dip below 0.788 has been met with quick buying pressure so far. This suggests that the market is still leaning long despite the looming resistance overhead. Let's bring it back to the daily view to recap the key price levels for your trading strategy. The most critical resistance remains the zone between 0.7927 and 0.7950. On the downside, initial support is found at 0.7834, with the ultimate floor at 0.7740. My unbiased prediction for the next 7 days is a 60% probability of a move towards 0.80. This bullish outcome would be reinforced if geopolitical tensions remain unresolved and U.S. inflation data surprises to the upside. Alternatively, there is a 40% chance we see a reversal back to 0.77. This bearish scenario would likely be triggered by a confirmed ceasefire agreement and aggressive SNV intervention. Keep an eye on the upcoming initial jobless claims on March 26 and the Michigan Sentiment Index on March 27. These reports will be the final pieces of the puzzle for the US dollar's performance this week. Watch for any divergence in the RSI on the daily chart as we approach the 0.80 level. Remember, this is not financial advice, and you should always perform your own due diligence. Trading involves significant risk, so ensure you are using proper position sizing and stop losses. Thank you for watching Explain the Charts, and we will see you in the next analysis.